Joining us now, JoAnne Feeney, Advisors Capital Management Partner and Portfolio Manager. Good to see you, JoAnne. You say economic growth looks good, and then Fed rates, more to come, and then you have a punctuation mark at the end, a question mark. So you don't know. But if it's so strong, there's a reason to wonder whether more are necessary.
Yeah, Joe, good morning. That's exactly right. And we know, and the Fed has told us several times, that they're going to be data dependent. So this Friday's jobs report should help us understand more. The fact is the economy remains really strong. There's no need for aggressive rate cuts here to stimulate. And more importantly, they really do need to make sure they get that inflation genie back in the bottle. There's been tremendous progress so far. And so investors really shouldn't count on rates coming down in a dramatic fashion. We think, over the next year, they will come down. And more importantly, though, we think that stocks are likely to be driven more by fundamentals, by earnings. And so obviously, this is a big week for that.
To do it just because the Fed perceived the current interest rate regimen as restrictive, that's kind of they don't know for sure whether we are in restrictive. It seems like we are if you use core, whatever, a PCE, whatever you want to use, and look where Fed funds are. But if the economy is so strong, though, you just have to ask yourself, should we just assume that the restrictive environment is eventually going to slow things, and there's a lag? Because we haven't seen it. We haven't seen it in the markets either. Even not the stock market, not the bond market, not the gold market, not anywhere have we seen it. So they've got plenty of other signals besides their perception that it's too restrictive. They're not listening to all the other things, though.
Yeah, well, they're restricted in the sense that real rates are high. Inflation-adjusted interest rates are high on a historical basis. But you're right, they're not seeing that much in the broader economy, except when you dig down under the surface. Look at industrials, for example. Those have been at a slowdown for quite a while. You look at Texas Instruments, they are a good eye into this. And they reported that, they've seen reductions in all the subcategories of industrials. Looks like that's bottoming now. So that could be a source of improvement and a source of improvement for stocks. But when you look at the consumer, it's a tale of two types of consumers. At the low end and the mid-range, they're really struggling with the consequences of the past years of inflation, and they're starting to trim their budgets. At the high end, not such an impact, and that's really what's been motoring the economy on from here. So
if there is a cutting cycle, you might buy different parts of the market. So how do you know what to do? You could either do growth or value depending on whether they cut. But if you don't know whether, do you assume there will be more cuts, therefore you go for whatever benefits from that?
Well, I think it's actually probably going to be more helpful for investors to look at the fundamentals of the companies. And as you know, Joe, we're investors in individual stocks, and we don't own the whole market, right? We're going to look around, and we should be careful about comparing this rate cutting cycle to ones of the past where value outperformed. Here, we have a really different underlying fundamental set of earnings possibilities, which really are driven by growth companies. And so we think that even if we don't get significant cuts, we're likely to see those growth companies continue to do well and deliver returns. And so that's why, this week's earnings reports are pretty important. We think Microsoft, Apple, Amazon all have very strong fundamentals, even though most of them are seeing earnings growth slow. We think that's baked into estimates. And we think that even if there is a bit of a pullback as investors digest the fact that growth is slowing more completely, that longer term, these are companies that are continue to create more and more value over time. So I think the rate discussion is secondary at this point to the underlying fundamentals of earnings.
So it's a dangerous world, obviously. And you even mentioned cyber attacks are growing. It's not just the Middle East. It's Ukraine, it's China, it's Taiwan. What do you do? Just sort of just have that in the back of your mind? You leave your phone on at night, just near your bedside, just in case, or you don't put it on mute, I guess. Right. No, clearly cyber attacks are growing, and the reason is because the threat surface continues to increase, by which I mean that there are more and more ways for hackers to attack and to cause damage. What we do about that is own companies like Palo Alto Networks for clients. We think that cyber security from a company like them is like a utility. You can't avoid
investing in that kind of technology for your company. But another way to do it from a broader portfolio perspective is to recognize that those threats are not just confined to the cyber world. Obviously, they're in the physical world, as we've seen over the weekend. And so a well-balanced portfolio will include some hedges against those kinds of risks, like owning Raytheon, owning a smaller defense company like Kratos, for example, which is involved in the drone business. These are ways to protect clients in moments of volatility. And also, we focus for some clients in, say, retirement phase on income that we can generate out of the portfolio. So even if stocks do hit a rough patch and are dragged lower, they're still getting the dividends. And a lot of folks are living off those dividends. You can own a company like AbbVie or Raytheon, like I mentioned, has a really attractive yield. And there's a lot of places you can go to build that kind of income into a portfolio to help insure against, the inevitable fluctuations in stock prices.
But you don't spend a lot of time thinking about a widening war in the Middle East or Ukraine, or that's not, I guess, you couldn't do anything if you were constantly worried about geopolitics, I guess.
Well, Joe, I always worried about geopolitics, and there are ways even there. The defense companies help. The energy companies also help to insure against that kind of a risk. But, there's only so much you can do. You can diversify and you can position in income-oriented stocks, defense, energy. But then you also, Joe, you didn't mention the China-Taiwan risk that's out there. And that's a bigger, broader concern. But still, you can own some more domestic-oriented companies that help to diversify against that kind of a risk.